Hello, G Money Junkies. I wanted to start a live show to broadcast on Facebook to help people understand how to invest in their future. Now, I've been getting a lot of questions about whether I should buy Snapchat stock. So that's what we're going to talk about today. Should you invest in Snapchat? Here we go. Alright, so Snapchat, it went IPO this week, and I believe the opening amount was $17 a share. And basically within a minute, it went up to $25 a share. So what does that mean? Well, let's take a look here. So it's been a few days, and Snapchat went up to, actually I pulled it up right here. So it started around $24.50 and actually hit a high of $29 a share. Now what does this mean? The people who owned it or bought it at $17 a share are now selling it for $29 a share on March 3rd, which was last Friday. So these guys are the ones getting rich off of the people who are buying it at $29 a share. And now it's at $22.81. So there's a little bit of an uptick here. But so there's this article, Snap rallies after a 2-day losing streak. Shares of Snap soared 6.4% to $22.81 on Wednesday, snapping a 2-day losing streak. This rally follows a 21% combined decline on Monday and Tuesday. Now, okay, so you have to understand that the people selling it are making millions off of the ones buying it, right? So who's buying it? I actually wrote an article about this. So let's pull up my website here. Millennials grab Snap shares. So this is an interesting article because the last sentence here is key. It's talking about a Snapchat investor. She does not do much investing generally, citing student loans and the high cost of living in the Bay Area, but got excited. We're talking about emotion here. Got excited by the talk of the IPO. One promising sign of the company's growth prospects, she said, even her parents are using it now. That's why she bought the stock? That is her fundamental analysis? Her mom and dad are using Snapchat? I mean, give me a break. This is ridiculous. All right, so let's do some real fundamental analysis. So I go to finance.yahoo.com and enter in the ticker symbol and just type in SNAP right here, Snap. You would type that right here. And then down would come the result. And let's just look at the stock. All right, so $22.81. The market cap is $26.4 billion, which means this is a $26 billion company. I believe GM, let's take a look at GM real quick, a car company. So it's half the worth of a car company. PE ratio, so this is the price you pay for the company divided by what the company earns, -37. Which tells me, okay, this company's not making money, but it's losing money. So let's look into more details here under statistics. Market cap, $26.4 billion. So that means you take all the shares that exist and multiply by the price. So if you wanted to buy this company, this is basically what you would have to pay for the shares. Trailing PE and forward PE. So the forward PE is estimated to be worse than the trailing PE, which means the last 12 months, you take those earnings and compare it to the next 12 months and those compared to those earnings. So you can find data provided by Thomson Reuters. All right, so price to sales. Now this is interesting because Facebook actually, when it started selling, when it went IPO, was a price to sales of 12, and this is 65. So there's more hype around Snapchat than there was about Facebook. Profit margin, negative 127%. All right, so these numbers don't really make much sense because obviously the company is losing money. But let's look at revenue. So we got a $400 million revenue stream from Facebook. So this is what people are banking on right here. 406% yearly growth. Will that continue? Probably not. It may continue for a year or two, but over the long haul, I do not think this will be sustainable. So let's look at the total cash. So it has about $1 billion in cash and $15 million in debt. So can they pay their debt bills? Easily. Easily. This is not a problem here. They got plenty of cash to cover it. In fact, if you take this revenue stream, they could pay it under a month of what they actually sell. All right, so that looks okay. Now their operating cash flow, this means you take how much revenue they're making and then subtract out their expenses. So they're losing $611 million. So could they cover this? Yes, if they cut expenses, they could do that. The other thing that they can do is just grow their revenue. So if they're growing at 406% a year, so presumably in 1 year, this would be over $1.6 billion. And then that would cover all of this. So that should not be a problem. All right. So could this company actually grow at 406%? If it grew at 100% a year, could it sustain that? Maybe for a few years. So the main thing here is, will it grow? Yes, I think it can grow. Is it worth $22.81 a share? Well, the bankers are selling out. The insiders are selling out. The employees are selling out. So think about it. Are you smarter than the guys who know the internals of the company's finances? Because if you are, then go ahead and buy. But those guys are selling. And they're going to go buy their Ferrari. And they're going to go buy their yacht. And you're hoping that it's going to go up higher. And I love the greater fool theory idea. So let's go back to my website and click on this one. Because I have... Do I have the graphic here? I do not. But this is a good book to read. Extraordinary Popular Delusions and the Madness of Crowds. Basically, people buy stocks, they buy items like a tulip bulb in the hope that they can sell it for more than what they bought it for. And that is considered a greater fool theory. And this is not the way to do it. And if you look back at the housing bubble back in the 2000s, that lasted from 2001 to 2000, I believe it was 2007 when it started popping. That was prime greater fool theory. So people were buying houses only because they knew that housing never goes down, it only goes up, and that they could sell it for more than what they bought it for, rather than looking at the money that they would be saving by buying it instead of renting. And by 2004, 2005, the money you were saving on renting did not really cover the new mortgage amount of the overinflated house price. So Snapchat is in a similar situation where you're buying basically a company that's losing money at a really high valuation. I believe when Facebook went IPO, it was at 35, maybe 32, but it was making 50 cents a share. So if you do a quick calculation, that was around 50 price to earnings. So 50 cents divided by 32, let's say. $32 divided by 50. Yeah, so 64. So it's about 64 price to earnings. At least they were making money, and Snapchat's not making money right now. So I would recommend everyone stay away from it, let things settle. And personally, I think any company that you should buy, any stock that you should buy, there should be at least a 5 to 10 year track record. So you can say, okay, they've been growing their revenues X percent a year, they've been growing their earnings X percent a year. You have a track record of the management, and You know what? I don't trust the management. Evan, I mean, the guy just graduated college a couple years ago. So what's it been, 4, maybe 5 years? And if you look at why he even started Snapchat, he wanted to send pictures to, let's call it, his friends, and that was the impetus of creating this app. And the stories I've read about him, I think he's in it more for the media and the fame rather than actually growing his company and working for the shareholders, which would be you if you bought the stock. So I don't have much confidence in the management. I don't know the management right now. There's not enough of a track record. So the next video I will do, and I'm not sure when I will do it, but I'm going to talk about how anyone can start investing. And really, you can start investing right now. And you might say, but wait a minute, I got tons of credit card debt. But here's the thing, credit card debt, if you start paying that off, that is investing. And investing is just basically choosing to grow your money or to prevent the loss of money. And there's always opportunity costs. So, and we'll talk about all of that when I do my next show. And perhaps that might be tomorrow or Friday. But anyone can start investing, and you just got to think of your finances and investing in a different way. And we'll get to that when we do that show. So stay tuned for that, and we'll catch you next time. Thanks.